Hey, good morning, everybody. It's Hammer. Today is Friday, June 20th, 2025. TGIF, baby. Is that a cliche or is it true? For me, today it's true. TGIF. I'm glad that we are ending the week. It's been a long week for me. So anyway, welcome to the show this morning. We are going to talk about some more about the Fed. So I did do a live yesterday where we did rehash what happened at the Fed meeting and some of the press conference. We're going to talk a little bit more about that. Mike Morano, good to see you on, my friend. Mike's been sending me some content lately, and I'm going to touch on some of that, Mike, here live so we can go over that. And I'm curious on your take on it as well. So also what we're going to talk about today is what would happen if the U.S. were to get involved with Iran. Right now we have not, but with the whole Middle East conflict, if we were to directly get involved, send over assets, troops, etc., right now, they're doing pure airstrikes from Israel. So I don't know that we would actually send over land troops, but if we were to get directly involved, we'll talk about what that might look like for mortgage rates and markets. And then we're going to cover what's going on with the calendar next week. We're going to hit some of the headlines, go through some of the things, and take a look and see if we can't figure out what do we think is going to happen with rates next week. So remember that you can join me live each and every weekday morning, 9:30 a.m. Eastern time. If you're watching the replay, don't forget to give me hashtag replay in the comments. Let me know that you were here. Don't forget to smash that like button, subscribe on YouTube, that good stuff. Randy Teakle, is YouTube working properly? I reconnected everything, so it looks like it's working today. Good to see you. James Mahan, good morning, sir. Angela Walters, great to have you there. Remember, y'all, comment. I know that a lot of you watch while you're doing something else, and I appreciate that, but do take some time to throw a comment or two in, and that's one of the reasons, not the only reason. They're fun, but it's one of the reasons why we do like the question of the day. It helps with engagement. It helps spread the word. Remember, if you want a quick reminder that I am going live in the morning, you can go ahead and sign up for a text alert. You can unsubscribe anytime. We don't sell your data anywhere. You can sign up at hmmr.io/reminder or use this cool QR code over here, and we will get you all set up and you'll start getting those morning text alerts. Welcome to all of the live folks. Megan Massell, Deb Dickinson, great to have you here. Mike Morano, I don't necessarily disagree. I don't know that I would call this a useless war. I think that Iran, if they do get nuclear capability and intercontinental nuclear capability, could be a very, very big concern. So, but anyway, above my pay grade. We're not going to get too far into that. So let's dive in. Talk about what we got going on this morning. Let's bring up the screens and we'll go overall. So quick recap. Markets were closed yesterday for Juneteenth. Wednesday's Fed meeting wasn't great for bonds. Let's zoom in together here. We'll refresh this and scroll over, and we'll kind of go over this. So looking at this is mortgage-backed securities. Here today, you could see that we actually started the day off with, overnight losses. You can see that here, but we've recovered those. Bloop, 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 and we're basically almost right where we were when we ended the day on Wednesday. So this is Wednesday right here. And I just brought that up to show, look at the volatility that we had kind of running into Wednesday. It's really not much different. This looks more like the Appalachian Mountain Range than it does actually maybe even the Rockies, because they're kind of pointy. So, it looks more like that than anything. Remember that this is mortgage-backed security pricing. So when it goes up, that is good for mortgage rates and pricing. When it goes down, that is bad for us. Taking a look here on Wednesday, we kind of did peak up at some of the high levels other than Monday morning, right? I'm sorry, this is Wednesday. And that means that this is Tuesday, the 17th. This is Monday. And then this was the previous Friday. Because we're missing a day. So this is the previous Friday where we ended the week. And take a look at where we're at right now. Look at that. Friday to Friday, you go up, go down, go up, go down, go up, go down. All this inter-week volatility, if you will, but yet it looks likely that we're going to end the week somewhere very close to how we ended last Friday as well. So, but Wednesday particularly, you can see here, the Fed meeting wasn't really great for bonds. We were up here to start things. At 2:30, it was at 99.19. After the Fed, statement and everything, we were at about 10 basis points lower. So we lost about 10 basis points there. A little bit of recovery through Powell's press conference. It's always around 315 that I tend to say we've kind of seen most of the movement, and you see that right here. And I don't know why it turns to there we go back to that. So anyway, and then we lost a little bit of ground on the day before Juneteenth. Nothing to get too worried about. So once more, for those joining, take a look here. This was where we ended the day last Friday, and we had improved from some weakness to get there. And it's very likely that today we will end very much in that same range. So rate sheets should end the week about the same as we began them. On Monday, we did start the day a little bit lower, but by the time pricing came out around 10 a.m., you could see that we were around 99.05. And what are we at right now? 99.03. So we're taking a look at rate sheets, where we were on Monday, which was the 16th. You could see that we were here. We'll probably be a little bit better, just a hair better. But I mean, like I said, basically, we're right about where we ended the week last week. 6.87 was where it showed off on Wednesday. We're down a couple of basis points. Pricing on Wednesday came out right around here. And now we're down about 10 basis points lower than that. So you're going to see slightly worse pricing. That's why if you take a look here and, just looking at all of these different, can we do 1 month? Will it? Look at this. Look at how just straight line rates have been over the last month. I mean, we're just not seeing any real movement at all in rates. They're very, very solid and stable. So reprice risk on the day is low. It's very unlikely that we're going to see much happen today. It's possible. Remember, we are in the summer. In fact, today is the first day of summer, and it's the longest day of the year. But it's a Friday, so it shouldn't feel like the longest day of the year, right? But overall, it really, we shouldn't see anything happening. Traders are going to leave on the day. We could see bonds drift a little lower. Some lenders may reprice a little bit worse, but shouldn't necessarily see that. I think that reprice risk on the day is low. So let's go ahead and let's take a little bit more of a look. I'm going to bounce this side to side so that y'all can see my pretty face, but we can go over this stuff at the same time. Now, Mike, also, I do appreciate you sending me. Those of you that don't know, Mike Morano will share emails with me periodically about some of the articles he's reading or things he's sharing. Like this is somebody, pushing something from Fox Business, probably on Fox News or whatever. Federal Reserve Chair Powell keeps rates at 20-year high. First of all, it wasn't just Powell, it's the Federal Open Market Committee. And as much as Powell has the most influence and impact, it is still a committee. And I'd have to go back and look, but I think that the vote for keeping rates the same was unanimous. Even though inflation is lower than it was in 2024 when he did cut rates. Why does that matter? It's there. So Jerry Vila, wondering what your thoughts on movement that should come from the supplemental leverage ratio. Is there any chance the ratio drops could lead to purchasing more of the 10 years? Let's hit that up next week. I didn't do any research on it, so I'm honestly not able to talk about it. I am not really giving a lot of, effect. My opinion on a couple different things. First of all, we're getting closer to the anointed day, the 4th of July, for the big bloated bullshit bill. That's a big deal. It's a big deal. It's a lot of debt. It's a lot of debt. You're not going to see rates drop when you have this huge amounts of debt. Also, I think everybody has agreed that, surprisingly, we did not see the tariffs hitting inflation in this last report, but it doesn't mean that we're off the hook. So, inflation starts to go up and all of a sudden the Fed's the bad guy. They're arguing that Powell is leading a Fed that acts too late. Many of you have agreed with that, and it's okay that you're wrong. No, I'm just kidding. You're certainly entitled. I could be wrong, right? But I don't think that we are wrong. I think we're starting to see some cracks in the foundation of the labor market. However, I agree with the sentiment that Powell says, which is that things are, just too uncertain. They're not willing to make any big changes. We expect more meaningful amount of inflation to arrive in coming months. So everyone says that they're late, but yet they're keeping things the same because they're not choking out the labor market. There's not significant signs of that. In his press conference, Powell talked about that the demand has dropped as well as the supply in the labor market. And therefore, there's a little bit of an equilibrium going on there. I don't necessarily disagree. And for everyone that wants to pick on the Fed, just do a little bit of mortgage math, y'all. What the problem with housing is affordability. And the reason affordability is a problem is because of prices, not rates. Rates in the sevens should, and we're not even, fully in the sevens, but rates in the sevens should not be throttling a housing market. What throttled the housing market was the reaction and things that happened during the pandemic. For those of you that are big Trump supporters, I got news for you. It was under his watch that the shit hit the fan and things started to go wrong. I mean, I'm not going to second guess anything that was done. I didn't agree with it back then. I don't agree with it now. It's only my opinion, but I think that the lockdowns and everything that was done and damaging to businesses has been much, much worse than anything that the Fed has done. I also think that we allowed the supply chain issues from China to be a big deal. And it shows how dependent we were and are on the goods from China, which you could argue is why some of the tariff stuff is being done. I don't know that I really believe it, though. I don't know that I really see us focusing on manufacturing that in the United States. Again, these are my opinions. Maybe it's why you tune in, maybe it's not. So the bottom line is I think that the state level governments and the federal government did a lot more damage during COVID, and we're paying for all of that stuff today than Powell ever did. Call me a fanboy. I'll tell you, you're right. I think Powell has done a fantastic job leading the Fed through, just some, just crazy times with the pandemic, with all of the stuff happened after that, with the heating, economy after that, with all of the monetary and fiscal policy that had to be dealt with. I just think that they've done great. So, and as far as Mike said, the Fed chair should be economists, not attorneys. I don't know. I don't necessarily know about that. Remember, you're talking to a redneck that never went to college. So I think I'm a pretty smart guy. I think college is overrated. I think that being an economist is overrated. I think that, that Powell can be very well educated in economic stuff and not be an economist. So that's just my take. I don't think that they should be. In fact, I think that if you have too many, everybody's an economist. I think that there's no diversity of thinking in the process. Fed Michelle Bowman is an economist, and if it were up to her, the Fed would be raising the Fed funds rate right now. That's just there. And you look at Christopher Waller, and he says, hey, he thinks that rates have room to come down in July. I don't know what he's smoking, but that's not going to happen. So you take a look here at the Fed expectations. Nobody really agrees with Waller that things are going to come down. It's a 90% probability that they'll be exactly where they're at. By the end of the year, though, market's still pricing in the idea of 2 rate cuts. And that's why the Fed meeting at the end of the day, it didn't hurt us. It didn't help us. Looking at the expectations, if we compare them, it really hasn't changed in, look at this. Why are you giving that stupid, I don't know why it switches to the arrow, but this has been almost flat for over a month now. Really no change there. So those outlooks haven't changed at all. Jay Rodriguez, yesterday was spring. Technically, according to the calendar, it was. In our neck of the woods, if y'all don't know, Route 40 has, turned around and just taken it on the chin yet again. This is Route 40, and you could see all of the flooding and craziness that was going on there. There's my lovely wife, and here you go. So this is Route 40, which we've had wash away, and look at those concrete barriers that the water just pushed all the way over. We are getting just pummeled with water over here in Western North Carolina, and a lot of the East Coast is. So, and California, of course, would love to have a tiny percentage of the water that we've been having. So anyway, with all that said, we'll go back to what we got going on. I'm going to go ahead and stop sharing the screen. Let's talk about what we got going on next week. Actually, let me throw that up there full screen and we'll go over that together. So let me pull this up and let's bring this. Give me a minute. I'm just pulling this up. So if we were, by the way, to get involved in the Iran thing, it could absolutely cause more of a flight to safety. That could actually help mortgage bonds a little bit next week, but I don't think it would be much for long. So taking a look here, you got Waller, talking some more on Monday. And at the end of the day, I don't really care because all he does is say the same thing, which I don't agree with. Hold on. What happened to my Presentify? Let's see. Control A. There it is. Okay. So on Monday, you've got more Fed speaking. We've got the services PMI data coming in there. That'll be a bit of a mover there. Bowman, like I said, she's a huge hawk, right? So you've got Waller who says, hey, we should be cutting rates, and Michelle Bowman, who I swear would be raising rates. Powell will be in front of Congress next week. And he's just going to be reiterating more of what he's already said, though. So there's really not anything I think that's going to happen to that. You'll see some small movement, but overall. And then on Thursday, we've got a lot of the normal stuff. Again, more Fed speakers next week, but you've got the GDP data. The final date is really the final data for Q1. Yeah. So it's final GDP data from Q1. It'll also have the PCE, the monthly PCE data that comes in, but it's this PCE data that matters. This is the quarterly PCE rather. This is the monthly PCE data that comes in. And, but you're not going to see any big move. It's the same thing that we've said before. There's really no expectation that we'll see any big improvement in inflation. It's generally going to wave the coattails of, it's going to wag the dog of the CPI. So the CPI came in slightly better than expected. We should see some PCE data that would arguably do the same here on Friday. Will it? I don't, and how much of an effect will that have? Not much. So realistically, we're going to see rates continue to stay stable where we're at. You'll see some day-to-day movement when we take a look at pricing and where we think pricing will go next week. Let me just slide this over a little so you guys get this. Okay. Taking a look at where, pricing will be, we could creep a little bit more back into the 6.9-ish area using Mortgage News Daily as just that straight reference point, but we'll probably stay in the 6.8s for now, heading into next week. I don't think that's going to change too much. So high 6.8-ish, 6 and 7/8 area is basically where we're going to be. So Mike said still a 9/16 and December 9th, 25% rate cut outside of CME FedWatch tool. When you say outside of that tool, I don't know what you mean by outside of that tool. Again, this is Fed futures. This is what's being traded. So their whole thing is that's what they built this on. So the markets are still pricing in 2 cuts by December. Yeah, I mean a September cut. So yeah, that's your first cut right here, and about a 70% expectation that we'll see that first cut, and then December is when we would basically, there's about also about a 70% expectation that we would see 2 cuts by December. So. But the dot plot, a lot of people thought we would see no cuts, that there's a possibility of that. We'll see. It depends. If inflation goes up, you'll see this start to drop. Eric, will fourth quarter deliver the rates, but at what expense? No, it's not. And remember something, y'all, I can't stress this enough. The Fed funds rate is short-term interest rates. It absolutely does play a role in longer term rates. We've seen it affect it. But what I wanted to show you is if you look at July of 2023, when we had that was the last Fed rate increase. And if we take a look, let's use where is Housing Wire, right? So let's use here, let's use this one. Let's use Housing Wire's, let's go back to, can we go back? I don't want all. What does all mean? All right. Well, that goes back to 2022. So let's do that, right? So take a look here. I mean, July of 2023 was right here. Look at how much higher. the Fed funds rate was. It was at 5. It was a point higher. We've gone down a point, and yet mortgage rates. Look at that. Look at that. Look at this. Right. And let me clean this up and use the arrows for a minute. All right. Let me use the arrow to show you. If we look at this, and I'm trying to make it straight, and we look at this, I mean, look at where we are compared to where rates were at their highest. So when you look at that, I mean, there was this time of outlier here where it kept going up, but we could go back on why that actually happened. But overall, this is when the Fed funds rate hit its highest level right here. And look at where rates have been, even when they came down in September. Remember, we came down in September, and the reason we dropped all the way to that low level was the expectation that that they were going to continue to keep cutting, and they didn't. And then rates went right back up, and they're back where they were. So you tell me, oh my goodness, if the Fed were to cut rates by a half point by the end of the year, what difference is it going to make on mortgage rates? None. Nominal. We're already pricing in the expectation of seeing that. It's more of what would the expectation be for 2026 rate cuts. We would see some really, really significant economic weakness or labor market weakness to think that the Fed is going to continue to need to cut going into there. It's just not there. As much as everybody wants to argue, at least argue with me, maybe I'm seeing something different than everybody else. But if we get dragged into Iran, lower bond yields, but again, nominally, I don't think, because especially we've already seen the price of oil jump up to the highest level since January, and it's come back down a little bit now, but oil prices did already bounce. They could move higher than that. We could see that, but I think that if we get involved, that will drive a short, small rally in bonds, but it's not going to be big. You're not going to see rates drop significantly, but it should have more of a bump than what we've seen so far with the conflict in the Middle East, but not enough to get overly excited about. So anyway, it's Friday, y'all. Have a fantastic day. What are you guys doing for the weekend? Let me know in the comments. Also, I am open to suggestions. Why do you guys watch this? Please let me know in the comments. I know that it's asking a lot for you guys to comment. There's 26 people watching. I would love to have 20 comments. Why do you watch this? Even if you want to just message me on Facebook or Instagram or YouTube, just message me. But I would like to know, why do you watch? Because I want to make some changes to the show. So, but I'm always saying that. I'm always tweaking. So, all right, my friends, you guys have a fantastic one. I will see you on Monday. Bye-bye.